The world's second-largest economy is in trouble. After years of breakneck growth, China's economic engine is sputtering, plagued by a collapsing property sector, weak consumer spending, and mounting local government debt. Beijing has responded with a flurry of stimulus measures in recent weeks, but skeptical investors and economists are wondering, is it enough to pull China back from the brink? The economy grew at just 4.6% in the third quarter, its weakest pace since early 2023, and below the government's ambitious 5% full-year target. As alarm bells ring, China's leaders are racing to shore up confidence. But their efforts so far have fallen short, triggering wild volatility in the stock market, reminiscent of the 2015 crash that wiped out $5 trillion in market value. Is China throwing good money after bad in the property sector? At the heart of China's economic woes lies its ailing property sector, which makes up about a quarter of GDP and 70% of household wealth. After years of overheating, the market is now in free fall, with tumbling home prices crushing consumer confidence. In a bid to stop the bleeding, Beijing recently announced plans to pump a staggering 4 trillion yuan, 161 billion, into property projects by the end of 2024. It's a massive lifeline for the beleaguered sector, nearly doubling current lending levels. But many analysts say it's too little too late. Larry Hu, chief China economist at Macquarie, called the measures incremental in nature, warning they may not be enough to stabilize the housing market. Investors seem to agree. Property stocks tanked 5% after the announcement, wiping out days of gains. Is Beijing stimulus push just smoke and mirrors? As economic storm clouds gather, investors have been clamoring for a powerful fiscal stimulus package to complement recent monetary easing. Anticipation has been building for weeks, with some analysts forecasting up to 3 trillion yuan in new spending. But so far, concrete details have been scarce. At a recent press briefing, China's Economic Planning Agency announced a paltry 200 billion yuan in accelerated spending, a fraction of what markets were hoping for. The muted response left many scratching their heads. "I don't know what the chairman of the NDRC was thinking with this," said Alicia Garcia Herrero, Asia-Pacific chief economist at Natixis. Frankly, the more they wait to clarify, the worse it can be, because people will realize there's no fiscal side to this stimulus, that it's all monetary, propping up stocks and so on. And that's quite dangerous. Are China's banks a ticking time bomb? While much attention has focused on the property sector, another looming threat could bring China's financial system to its knees: the precarious state of its banks. Years of easy credit and questionable lending practices have left Chinese banks saddled with a mountain of bad debt. By some estimates, non-performing loans now make up a staggering 5 to 6% of total bank assets, a level that would spell disaster for most financial systems. The situation is especially dire in China's poorer interior regions, where state-owned banks have been propping up unproductive zombie companies for years. As one analyst put it, you're talking about something that is at least an order of magnitude worse than past banking crises in the U.S. Beijing is reportedly considering injecting up to 1 trillion yuan to recapitalize major state banks. But with credit demand weak and the broader economy struggling, even this massive cash infusion may not be enough to jumpstart lending and growth. Is China's stock market rally built on sand? Despite the gloomy economic backdrop, Chinese stocks have been on a tear in recent weeks. The benchmark CSI 300 index surged over 30% since late September, adding a whopping $3 trillion in market value. But the astonishing rally is showing signs of strain. Wild price swings have become the norm, with stocks routinely swinging 5 to 10% in a single day. The Chi-Next index of tech startups skyrocketed 67% in just 7 trading sessions before giving up nearly half those gains. The volatility has uncomfortable echoes of 2015, when a similar stimulus-fueled rally ended in a spectacular crash. Then as now, retail investors piled in with borrowed money, amplifying both the boom and bust. While regulators have clamped down on some of the shadier financing practices from 2015, the current frenzy still has many on edge. Daily trading volumes hit a record 3.43 trillion yuan last week, with retail traders pouring over 100 billion yuan into stock ETFs in a single day. Some short-term investors who joined the rally earlier may choose to book profits, increasing market volatility, warned Meng Lei, a strategist at UBS. The question now is whether this rally has staying power, or if it's destined to meet the same fate as 2015. Can Xi Jinping engineer a soft landing? As China's economy teeters, all eyes are on President Xi Jinping. After years of emphasizing qualitative growth and deleveraging, Xi appears to have made an abrupt U-turn, greenlighting a wave of stimulus measures to prop up growth. But walking the tightrope between short-term stability and long-term reform will be no easy feat. Push too hard on stimulus and China risks inflating new bubbles and piling on more debt. Not hard enough, and the economy could slip into a protracted downturn, potentially threatening social stability. So far, Xi's approach has leaned heavily on monetary easing and targeted support for sectors like real estate. But many economists say bolder fiscal measures are needed to tackle the economy's underlying structural issues. The stimulus package announced at the end of September will take time and patience to boost growth over the next several quarters, said Claire Liang of Morningstar. The actual implementation of the policies and evidence of the policies' effect on macro improvements, such as stabilizing housing prices, improving housing transactions, and substantial uplift in consumer confidence, are needed before making meaningful portfolio adjustments. Is China's economic miracle over? For decades, China has been the world's growth engine, consistently delivering eye-popping GDP numbers that were the envy of the developed world. But as the country grapples with an aging population, mounting debt, and diminishing returns on investment, some are beginning to question whether the era of miraculous growth is coming to an end. We've talked a lot about consumption. We've talked about investment. We've talked about trade. But something we don't talk about very often are Chinese banks, which are the method by which capital makes it into the Chinese economy, like most economies. And that is also completely broken, said one analyst. The government's official statistics paint a rosy picture, with GDP still growing at a respectable 4.6% clip. But many China watchers are skeptical of the numbers. Some estimate that real growth could be close to zero once inflated figures are stripped out. It would not surprise me if we had an actual forensic audit done on Chinese books. If the Chinese economy grew larger over that entire period, it was actually roughly the same size as it was over the period of the Chinese life, noted one expert. As 2024 draws to a close, China finds itself at a pivotal moment. The decisions made in the coming months could determine whether the country can navigate its economic headwinds and emerge stronger, or whether it's destined for a painful period of stagnation and decline. The stakes couldn't be higher, not just for China, but for the global economy that has come to rely on Chinese growth. As one analyst put it, what I can say is that Chinese authorities are missing the mark. They are not doing what should be done while leaving structural problems unattended. Whether Xi Jinping and his economic team can thread the needle remains to be seen. But one thing is clear: the world will be watching China's next moves with bated breath. Subscribe for more.